Hello and welcome to Pro Trader Strategies Market Commentary for Wednesday, November the 15th. My name's Eric Wilkinson. Some of you may recognize me as the Wolfman from CNBC, Fox Business, or even the Wall Street Journal for my commentary on everything from economic to geopolitical and market analysis. Please keep in mind that everything that we talk about in these market commentaries is not a solicitation to buy or sell any of these securities or strategies. At the end of the day, we're here to teach you some different strategies that you can implement into your portfolios, but please do that in your own way. The reason why I can't give you a recommendation on a particular stock or strategy is because I don't know your risk parameters. I don't know what's in your portfolios, and therefore what I'm doing could be counterintuitive to what you are already doing. And please remember that past performance of any trading system or methodology is not necessarily indicative of future results. Having all that out of the way, let's get it on. Not a whole lot of economic data across the pond today, maybe some economic data in the form of unemployment claims and things of that nature, but for the most part they came in line with expectations. But here in the United States, we talked about getting the CPI, which is the Consumer Price Index, month over month came in at 0.1%, expected to be 0.1%, no revisions to the last month's number. Now keep in mind, last reading we got yesterday was on the PPI, which is Producer Price Index. We saw a bit of an increase in that number, so the producers are having to pay a little bit more for some of the materials and things of that nature going into their products, but they're not able to pass that on to the consumer. We also got core CPI, which was is the Consumer Price Index, came in at 0.2%, and then core retail sales, which strips out autos, came in at 0.1%, expected to be 0.2%, but they did revise last month's number up from 1% to 1.2%. So that kind of balances that number out a little bit. And then we got retail sales, which includes the autos. And the reason why we look at core retail sales a little bit more is because the volatility in the sales of autos, they're a little bit sporadic. So they like to strip out core retail or strip out autos, transportation for that number. And but with retail sales, it came in at 0.2%, expected to be unchanged, and they revised last month's number up a little bit from 1.6% to 1.9%. Now that autos number is kind of moving higher because of the hurricanes. We're still seeing some of those inventories of the automakers kind of selling off some of those inventories. Plus, there's a lot of great deals out there. It seems like everybody's pretty much doing a 0% finance for up to like 72 months or something like that. So I'm sure that heading into the end of the year, with those guys trying to get rid of some inventory, and with those low interest rates, and people are starting to jump on that. Then we got Empire State Manufacturing coming in at 19.4, expected to be 25.5, so lower than expected there. And finally, we got crude oil inventories. It came in at 1.9 million barrel build, expected to be a drawdown of 2.1 million barrels. So last 2 months, we have had quite a build happening when we were expecting drawdowns. And in that time, we have seen crude oil really start to move higher. So it's starting to look like crude oil inventories building up should cause some downward pressure. I think a little bit of the Saudi Arabia stuff that's going on there is still kind of holding on to some gains here. But if we're going to continue to see builds here in the United States, it's going to have to put downward pressure on crude oil, despite the fact that it has bounced off the 78 Fibonacci level, moving higher now, even after that number it continued to move higher. But down on the day from the yesterday's close. So at the end of the day, we are just slightly in negative territory, despite the fact that this bar looks like it's positive. That includes the overnight sessions as well. Anyway, on to gold futures. Gold futures are negative on the day, back below this Fibonacci level. I talked about this a couple of times. That Fibonacci level is not going to act as a support and resistance anymore, and that's proving to be the case. It really is that it is comfortable right on that Fibonacci level because it lines up with the point of control where the most time and volume has been spent over the last year. So that's where people have put their money where their mouth is. Nobody's making money, nobody's losing money. Those people are usually pretty happy when you have the broader market. in at those levels. And then we can look at the bonds. They moved higher today, quite a bit actually. They were up over a point, moving to where the most volume has been spent. That's kind of where we're kind of hanging out right now. I've talked about the bonds needing to go lower as interest rates start to increase. Bonds are really just acting as a flight to safety, as right off the open we saw the equities really take a nosedive, and that caused bonds, call it gold, to move higher, probably even crude oil for that matter, despite the fact that we saw a build. The build happened well after, or that inventory number came well after the about an hour after the open of the stock market, but still more of a flight to safety move in those three commodities. Then on to the VIX. We got a big spike, as you can see, in the VIX as the overall equities slammed down. We're up into the 12 handle. We're well into the 13 and 14 handle right off the bat. This VIX is getting really jukey, which, that's kind of telling you people are getting a little bit nervous. That has to do with a lot of put buying going into different aspects. So when people start to buy puts, that drives the VIX higher, as the puts are more of a fear indicator and people looking to protect some of those gains that we've seen on this massive move in the equities. And as you can see with the Dow Jones Industrial Average off 100 points, but was much lower than that earlier today. Markets kind of bounced, and we're starting to see a little bit more of a correction again from that area. But as you can see, the low here was 23,271, so about 30 ticks actually to 23,344. So, 23,242, so about 50 ticks lower than where we are now, so almost 150 points on the day. And then we can see here with the Nasdaq down quite a bit today, but well off the lows that we saw right off the morning. We can even break this down into a 30-minute chart just to give you a bit of an idea of that move that we saw right off the open. This is the opening prints basically, and the market slammed down, got everybody short, and then of course the market just rallied back dramatic, almost as dramatic as the sell-off happened, and now we're starting to see a bit of profit taking going on there. Same thing going on in the E-mini S&Ps. As you can see, the market's down only about 11 points, but was down quite a bit more on the open when we traded down to, I think it was 25.55.5, so about 12 ticks lower, 11 ticks lower than we are now. So basically regaining half of those losses that we saw right off this opening print move, and that was down to the 25.55.5 area was the low on this particular one right here. So you can see we're off. Taken back, I should say, half of those losses, but starting to give up a little bit now as the market's really kind of acting quite erratic right now. That's about it for the equities. Now on to some trades that I've done. The target trade I forgot to tweet this out till like late last night. I thought about it and then I was like, well, it's already said and done, but forgot to tweet this out for you guys. And I went into the November only in my margin account. I actually had a working trade in my IRA. I couldn't get the strikes or the price that I wanted. I'll talk about that one in a minute. But in my margin account, I went into the November monthlies and sold the 55 puts for 38 cents, and I had to buy them back for 51 cents this morning off the open. It looked like it was going to start rallying, but it was a quick move to the upside and then slammed down, and I chased it. Like literally, seemed like in the first minute that market really started coming down. I put in a bid and the market started falling away, and I just actually bid up through, tried to bid 55 cents and got filled at 51. So that was a pretty dramatic move, and when I saw that start to happen, I was like, get out, and that's where I did there. But in my IRA, I was actually trying to do the same 55 puts, selling those 55 puts in my IRA, and then trying to buy, I think it was like the 53 3 puts or something like that, but the market was just really wide. I think, as a matter of fact, the one that I was trying to define the risk in was 0 bid at 165, which was ridiculous. So I just priced it in to try and buy that option for a nickel, and nobody facilitated that trade for me, so that did not happen. But in the earnings for tomorrow, we've got Cisco coming out with earnings. Don't know if I'm going to play Cisco. It does have really high implied volatility. I would probably play this to the upside if I were going to do it, but I'm probably going to stay away from Cisco. But I am going to play Walmart. I'm going to play Walmart to the upside, just like I did with Target. One thing with Target, the caveat with that was they did beat earnings, which, you know, one intuitively would think that would drive it higher. But then there was some fodder coming out in the earnings call that for this holiday season, they're going to use their stores as the fulfillment center for some of these online purchases. And that's going to ultimately hurt the stores. They're just not going to have very much profit margin on it. If you think they're selling it for the same prices in the store, and then they got to pay for shipping. They also have to pay for somebody to stock that or take that off the shelf, which is another person. That just doesn't really make for a streamlined, lean Six Sigma type of fulfillment center. So profits could be getting eaten into for that earnings season. That's what really has been the downfall of Target today. When they started talking about using their stores as a fulfillment center, the investors did not like that whatsoever. Walmart not doing necessarily the same thing, so probably be playing Walmart to the upside, despite the fact that they've had a nice run. I think that they're going to do well with that. And that's about it. That's all I'm doing for earnings. Really getting thin on earnings, so I'm going to be starting to look to start adding some other things to my core positions on the long term. So keep your eyes out for that as these earnings start to dwindle away. But Friday, we're going to be doing a webinar on the long call. Now, I haven't done a webinar on this in quite some time, so you're going to need to check this out. Even if you're a savvy trader, I'm going to be talking about little ancillary things that will cater to you as well. So check that out. I'm sure everybody will be able to take something away from this, from the new trader to the very savvy or professional trader. So go to protraderstrategies.com and sign up for that. If you can't take that, take it easy.